Hello and welcome to Business Today. I'm Siddharth Zarabi and we continue to dissect the massive shocks all across the world as Donald Trump has unleashed what we are calling the world trade disorder and what it means for not just the world but particularly for India and Indian markets. No better guest than market veteran Ajay Bagga, who is here with us. Ajay, welcome. You've been tweeting furiously about the impact, and what I wanted to do on the show today is to have a conversation where many of the people who are invested in the markets and have had a worrying weekend and a worrying Monday as well, a manic Monday, they get to understand from you how they should look at the future, because the past is behind us. But nevertheless, the first point, the rebuilding of the world order, as you call it, from a market perspective, what is this rebuilding of the world order that you have been writing about?
For nearly 100 years, right from 1930 onwards, we have not seen this level of tariffs, Siddharth. It has not happened on this scale that you have protectionism, which is so pervasive. And what is coming out, like Vietnam offered zero tariffs. They have been told by Peter Navarro that from the Trump administration that no, zero tariffs are not enough, non-tariff barriers and transshipment of Chinese goods have to be stopped. Same way, the European Union has offered zero tariffs, but Trump has kind of rejected it and said, I want to see VAT, I want to see other non-tariff barriers removed. So we really don't know. This started, Siddharth, as a means to an end, but tariffs have become an end for this administration, and that is worrisome not only for markets, for investors, but also for the Republican Party, because what it will lead to is higher prices, lower economic growth, lower global trade, and a full-fledged trade war. That is what is looking like, and markets are discounting that ahead. Today we are seeing a bounce, but this bounce is not the bottom. This is just a bounce.
A dead cat pounce, as it is called. Ajay, I want to take this point forward. You talk about the damage to international relations, economies, trade, and markets, and you say that it is likely to be lasting. Taking your earlier point, we have 4 years of Trump.
Yeah.
Is the damage likely to last 4 years? Is that what you are saying from a market perspective?
No, I think he has front-ended it. If you look at 2016 to 20, Siddharth, first he brought in tax cuts, first he brought in deregulation, then around 2018 he got his hands around tariffs. This time he has started with the playbook on tariffs. Now they will go to the US Congress to ask for tax cuts. Now they are going to bring in more deregulation. So I think he's in a hurry. One, that the US Congress does not take back the authorization. Under Article 1 of the US Constitution, only the Congress can levy tariffs except in a national emergency. So on day one, he signed an executive order saying it's a national emergency. This is what Nixon had done in 1970s, and he's using that national emergency provision. Otherwise, the US Congress has to pass tariffs. So there were checks and balances, those have been removed. Second big thing is on the scale of the tariffs. So it seems that he's out to change the last 40, 50 years, and especially the emergence of China. China, which has hollowed out the entire Western hemisphere in terms of manufacturing, has become the factory of the world. He wants to decouple the US from the Chinese supply chain. Now, how possible is it? We don't know. And it will be messy. It will be leading to a lot of dysfunctionality. That is what we are feeling.
In terms of the response, what we clearly see that not every country is joining battle with the United States.
Yes.
Japan is not joining battle. Vietnam has completely surrendered. And India is following its own policy. In fact, we are amongst the few countries that even before this announcement have been engaging at very high levels, and we have a formal agreement to negotiate a bilateral investment treaty. I think there are virtually no countries with which there is a formal understanding to negotiate a bilateral investment treaty. Yet we saw this reaction on the markets. Why? Are market investors discounting India's sort of unique position relative to other economies, or are they just caught up in the generalized worry?
No, I think it's the generalized worry. One, second, it's generation of liquidity. If you see last week, silver fell some 14%. Gold fell. Now, gold is normally a safe haven asset. You see gold being bought. US treasuries were sold out. US treasuries were getting sold. So, the estimate is $40 billion of hedge fund positions had to be refinanced. And again on Monday, there was a margin call of about $30 billion on hedge funds. So they were taking out liquidity from wherever you can. If you see on Monday, we had 12,000 crores of equity, 9,000 crores of FI selling in the cash segment in India. So it's more a generation of liquidity. The India story is very much, quite stable. The structural domestic story of India is multi-decade story. What is happening right now is the cyclical story of the globe has turned with a negative momentum. Sentiment is spoiled, liquidity has tightened, financial conditions are very tight. They are like the regional bank crisis of last March. We have reached that levels. If you look at the indices, and there is a big shortage of dollars in the global system. Normally, the Fed steps in and supplies dollars. Right now, there is tightening. So, what is happening is US treasuries are being sold, gold is being sold, and markets like India, which are very liquid, which allow you an easy exit. If you look at Taiwan, they put a short selling ban. Turkey put a short selling ban. Korea, after 2 months, has just removed a short selling ban. Again, they will bring it back shortly. So there are very few markets where you can move in and move out without a big impact. And we were falling for 6 months or were sideways for 6 months. We are down from the all-time high of September. We are down 14%. Damage was done, and still we saw selling. That was more liquidity. I would suspect more liquidity generation than actual India story worsening or feeling that India will be hurt very badly by tariffs. Yes, there is a 0.3 to 0.5% on a worst case scenario impact on our GDP.
Right.
You have levers. If you do fiscal stimulus, you do monetary easing, you do a reform stimulus, and
Right.
you give targeted subsidies, you can get above it.
Ajay, I am reminded, and uh, I was a reporter spending time inside, outside the finance ministry when the 2008 shock started to develop. And when you were answering it, I almost went back to that time when, if you remember, on a particular day, basically the US money markets completely froze.
Yes.
The point I want you to tell our viewers is we saw the recovery of the US market, global markets, and the Indian market. It was a journey after that worst day. Compared to that, how will the journey be from here on for the Indian market and for the US and global markets?
Yeah, I think three very big crises we have seen and two mini crises over the last 25 years. So say .com, if you take, it was very high valuations, but there was no liquidity issue. The market just sat down on its own weight. Then you look at 2008, there was a massive subprime issue, and then there was a liquidity issue for large banks. So that was actually a sheer liquidity issue, and a lot of note printing had to happen. Come to 2013, the taper tantrum, markets were fragile. US withdrawing some amount of, tapering some of its stimulus shouldn't have caused the kind of crash it did, but it was very short-lived. Again, at moment they reversed it, it came back. Same way Trump tariff one in 2018-19 when China depreciated its currency by 10%, all emerging markets started selling off, US started selling off, and Janet Yellen had to come running. Siddharth, you will remember that from QT they went to QE overnight. Overnight
Yes.
she went to easy.
Overnight shift.
So this time around, and then the last one is the pandemic where the economies just shut down. So there, the biggest stimulus in history was provided. India was very smart again in terms of that stimulus. So we don't have that excess which is being seen, say, in the US markets based on that stimulus. Where are we today in comparison to all this? Is there a liquidity issue? No. Will there be a slowdown in global economic growth? Yes. On 105, $110 trillion of global GDP, Siddharth, about $1.5 trillion is the expectation of a slowdown. 1.5 trillion. So less than 1% of a global drag. Third, is there ammunition with the central banks? Yes. Fed is not sitting at 0% today that it will have to go to negative rates. It was sitting at 5.25. It has cut 1%. It can easily cut 2 more percent. Markets are now discounting 1.25% of cuts by the Fed within this year. I think markets are over exuberant, but at least 3 cuts. So maybe 75 basis points the Fed can cut. The European Union is showing 88 basis points of cut. So say 75 from European Union. Bank of England has some amount. Japan, anyways, is a stimulated economy. Still, they have raised rates once. They can go back to negative. So, is there ammunition with central banks? Yes. Will it be needed? Doesn't look like. Because overall, the health of the global economy was okay till these tariffs came in. Now, tariffs impact 33 billion out of that 110, 105 trillion. 33 trillion gets impacted by tariff, out of which US is how much? 3.3. So that gives you a dimensioning of the issue. 110, 33, 3.3. On 3.3, there will be a core which is essential. There will be a core which you can try and make locally. Say cars, you don't buy a car this year, but that's a $30 billion hit to automakers' margins straight away. If that 8 million of cars don't get bought this year. And it won't stop. It won't be a nice, neat thing where 8 million were sold US make, 8 million were foreign make. So US consumer will say, I will keep buying 8 million US cars. No, maybe they will buy 6 million. Once sentiment gets spoiled, you can't control that sentiment. That is what is really spoiling the market mood. The way it is done, yeah, you want to be a deal maker, then you have to be a deal keeper. That's what I wrote this morning. That
On that note, Ajay, let's listen into what Donald Trump had to say, because this bit about deal making, he seems to be confounding even his most ardent supporters by so far rejecting deals and overtures. Let's listen into what Trump had to say in the context of the European Union, and we'll come back to this discussion.
Yes.
We have a deficit with the European Union of $350 billion, and it's going to disappear fast. And one of the reasons and one of the ways that that can disappear easily and quickly is they're going to have to buy our energy from us because they need it. They're going to have to buy it from us. They can buy it. We can knock off $350 billion in 1 week.
Ajay, not for a history lesson, but it's clear that this seems to be a rolling crisis. He is not satisfied with Japan saying zero, Vietnam saying zero, and so far by all indications, while they have been sort of muted about India, we have already put a lot of proposals on the table. So with the European Union also, so what is the end game here? is the end game to reduce and knock off the deficit in one go? I mean, it's very hard to comprehend, frankly.
And it won't happen because the factories are not there. Like he's talking about copper. Copper, Siddharth, after you find the reserves, it takes 15 to 19 years to set up a copper mining operation which can go to market. A car factory, you need 3 to 5 years. You need some 200 suppliers to come in. Now, and 2018 numbers are there in front of us. When the steel tariffs came in, 1,000 jobs were created in the steel sector. 75,000 jobs in the US were lost in the users of steel sector, right from automakers to construction. Everybody, Harika, everybody's cost went up 25%.
And that is why Ajay, sane voices like Bill Ackman, even Elon Musk are saying give a pause. If nothing, at least give 90 days time for negotiations to pan out. The point really is, it may not be clear to us, and maybe only Donald Trump and some of his closest advisors know this. But let me come back to the domestic front. In the near term, even as the US and what it does remains unclear, what should the preferences of investors be as far as the domestic market is concerned? Which sectors can offer a ray of hope and some sort of stability?
Yeah, I think stay away from the export-oriented sectors, though you can take a contrarian bet and say this is the time when, but we don't know if it is the peak uncertainty yet. Tariffs-wise, we have reached peak uncertainty. From here, things should start getting better.
But why stay away from export counters? Because the flip side, Ajay, sorry to interrupt you, is that India is also pursuing multiple other trade agreements. Some people are saying that it can be India's moment. We can replace some of the other supplier countries which have higher tariffs.
See, Siddharth, what happened in the last 5 years, post Trump tariff 1, when China plus 1 came very strongly, and then post COVID, we have not really covered ourselves with glory. PLI has been successful in limited ways. We have become a defense exporters. I think you can count those successes, but we don't have that capacity. Textiles, maybe you can have benefit over Vietnam and Bangladesh with the tariff differential, but you don't know if that is a stable differential. Tomorrow it can get changed because this was done by one imperial president signing off. There wasn't a give and take. So we have to wait for the bilateral trade agreement to figure out. So what I'm saying is 6 months might be better. Stay away from IT, from pharma. Within pharma, there are 5, 6 sectors. Hospitals look good. Diagnostics, the volume expansion is crazy. It's very good. Indian suppliers into the pharma, US exporters, you can stay aside because you don't know when tariffs might come onto them. IT, I think results will be dismal, and I don't want to be an IT manager today and coming and giving earnings guidance to Siddharth day after, because really, when we can't know anything, how will they know? Your big order flow will stop. I was reading a lot of the US.
So does that mean, Ajay, does that mean that this year is almost a gone case from a returns perspective? Why I am jumping to that topic is it's already April. By the time this immediate dust settles May, then if you are advocating to be cautious and in a way stay on the sidelines or be very selective for 6 months, तो लगभग पूरा साल चला जाएगा.
Yeah, that is true. But the good news I'll give you, the domestic economy continues. So your 60% of your expenditure is household and nearly 15-17% is government. Those two stay. That is going to be spent. So where is that going to be spent? Your FMCG, your consumer durables. Auto I would not touch because of the headwinds from abroad. Metals, again, pricing will come from abroad. So no matter, your companies are the best, but sentiment is spoiled. Industrials, infrastructure built out by the government, aviation, hospitality, hospitals within pharma, diagnostic within pharma, Indian suppliers of pharma, I think we have a lot of other segments which we can carve out, which are more domestic. And then the biggest of all, banks and financials. You will not get very great results this time around. There will be a fall post the results and the guidances might be muted. That will be a good time again to load up on private sector PSU banks. I think those will outperform. So we have enough. Overall, where the market will go is looking difficult because of the policy uncertainty. But again, we are probably near the peak uncertainty because the
No,
market
so
has.
let's take this point about peak uncertainty that you have said a couple of times and again go back to the macro picture. One of the things that is panning out on the macro side is the crude oil price. And very clearly, since you mentioned government as well, despite the government raising excise, the hit has not been passed on to consumers, and therefore, theoretically, consumption or whatever 35,000 odd crore that might get raised is not going to come from consumer pockets. Pump prices have been frozen for the longest now. How big a factor, positive factor, is the crude oil decline, and how does that overall weigh on our fiscal picture and therefore macro stability?
Yeah, it helps. It helps. Every $10 fall in crude has a 0.1% impact on the GDP positive, and it also brings down your inflation by about 0.25. Again, provided it is passed on. This government is not passing on, but again, that 2% on excise has already been paid out. That's the LPG subsidy of last year, which was not put in the budget. So that 35, 40,000 crores will go
Is
into
going
the
to correct.
for the LPG. So both of already customers have enjoyed it. But the good news then on a falling oil is our GDP intensity of oil has gone down, but our oil consumption went up 9% in March. So that I think it's a good move that the government is keeping the prices high. We should go more towards renewables. Solar is India's petchem. Electrification is India's petchem. We should really subsidize, moving it to renewables. NTPC is talking of making small nuclear reactor. That will take 5 years. It's not tomorrow's thing. But abhi jo kar sakte hai, what we can do right away is solar, is wind, and commissioning a lot more of EVs. I think that will help. Uh, and
And
that
and how do you respond to Piyush Goyal's comment that happened in Mumbai just yesterday evening, where he ruled out BYD, which is spoken of almost as a Tesla beater, if not a Tesla killer, as a product, and he also had this comment about China and the. I think what we need to read between the lines is that the government will be very, very cautious and prevent dumping of any sort of China. But how do you respond to this comment by the Commerce Minister with regard to BYD?
No, I think we need to protect ourselves, and clearly you can say that, oh, you are laying out the red carpet for Tesla, but you are stopping BYD. But these are all owned by the Chinese state. End of the day, there is somebody standing there, but they are not the real owners. One is that. Second, your point on dumping is spot on. Siddharth, if you analyze after 2002, when the ASEAN FTA was signed and they made the mistake of bringing China in, from 2021, the industrial output of Vietnam, of Indonesia, Malaysia, all the top 9 out of 10. Singapore has done well. It's a very well run country and it's a smaller country. They have managed, but 9 out of 10 industrial output has not grown. Thailand cannot compete with China on textiles, imagine. China is flooding Thailand with low quality goods from stuffed toys to textile. The biggest Indonesian textile maker just filed for bankruptcy. Shritex is the company. They lost 88,000 jobs in textiles last year, Indonesia, and they're going to lose 250,000 jobs more this year because of Chinese dumping. So Chinese dumping is a reality, and what happens is this was without US. Now, if the US puts up a tariff barrier, that more of that will come, and that's the interesting part. 2019 Chinese trade gap with US was about 300 billion. It is still 300 billion today. But overall Chinese trade gap with the world has gone to 1 trillion. What is happening? 500 billion has come up with the global south. So what that is transshipment. You are making most of the value add. The plastic part on it or the label on it says made in Vietnam and it gets shipped to the US. You have made up factories in Mexico or Canada or Vietnam or Malaysia which are owned by Chinese. Most of the value addition is done in China and then you're doing transshipment. So all this, what Trump is saying, his theoretically is right, but the way he's doing it will really, destroy confidence. That's why markets are reacting. But India has to be very careful. We are a huge consumption market worth, nearly 1.4, 1.5 billion trillion dollars rather now. If you take the entire market, we are about 2.4 trillion dollars. So, lot of dumping from China will come, and ASEAN is facing this specter of deindustrialization. People like Indonesia have filed hundreds of complaints in WTO. Asia ex-ASEAN has filed 2,700 complaints against China in the last 3 years with WTO. That's the amount of dumping that was already happening. Now you take out the US out of this. Imagine the kind of dumping that will happen.
Absolutely. Let me also take up one macro factor and then one final on corporate earnings. In all of this, what do you expect from monetary policy? That announcement will come tomorrow. What's your own sense? What should be the ideal line and length that the MPC sets for the pitch?
I think they'll do a 25 basis points tomorrow. Liquidity they have injected. They have spoken of 4 lakh crores today of fresh liquidity. So CRR cut is ruled out. That was the signaling they gave. And secondly, global financial conditions are tightening. So they will be watching that very carefully, that is there a sharp fall in our exports? Crude is giving us a lot of cover, so that helps. Our February trade gap was very good. In fact, even gold, Siddharth, quite interestingly, the evidence is the Indian consumer is not buying so much gold. They are selling the gold holdings they had and cashing it. Rather than buying gold at these historically high levels. So that is also giving some amount of cover to RBI on the FX part. Inflation is in control. That's the good part. Seasonality also helped. The food inflation went down because of seasonality. We are getting a good crop coming. Baisakhi is coming. A week from now, harvest has come. It is quite good. So that way, there's a lot of monetary space, and government has been quite conservative. They have actually cut the fiscal deficit, and the tax revenues are better than forecast. So RBI has monetary space. They will go into easing, and they will stand ready to step into the economy if anything major comes in. But they will hold their ammunition. So one rate cut tomorrow, one in June, and one towards the end of the year in October or November is what we expect in the rest of the year.
A cumulative 100 basis points cut will certainly provide overall these 3 cuts that you have spoken of on the back of one that's already happened. You know, 2008, the big term used to be decoupling from the world. India is decoupled. You know, I'm just wondering from a corporate earnings perspective, what should we expect? A decoupling driven by domestic factors, or will the headwinds of the volatility in commodity prices, inputs, and other associated factors weigh heavy on them?
See, about 25% of the top 200 companies' revenues come from abroad. So we are coupled. And, you and I go back a long way. I have done enough shows in 2008 with you. I remember I was with you on Brexit Day, and we were saying this, on the day Hillary Clinton lost, how the market went that day. and it ended in the positive by the end of it. We were covering it together. So I would say it's a fallacy to say we are decoupled. No, because of the capital flows and the portfolio flows, we get coupled. It's just that we can withstand some amount of heat and then everything comes in. This time around, what has surprised us is that it's come through very fast. Already we were falling, and then 9,000 crores on Monday of FI selling. It was a very concentrated sale. So maybe now people have realized 2008 FIs used to crib that when we came in, you were as big as Taiwan. When we are trying to go out, your door has become smaller than Thailand. There was an impact cost in 2008. That's why we went down 60%. And there was no domestic of this size. I used to run a fund with 4,000 crore AUM or 5,000 crore AUM, and I was in the top 10 funds at that time.
Yeah. And you know, 9,000 crore being sold, but 12,000 crore being purchased by DIIs at the same time.
So that 40,000 a month coming in, 40,000 crores coming in was not there. Yesterday, if the DII was not standing, imagine 9,000 if it had come through, where our market would be. I'm tempted at times that why are you buying? Just let it go out, because a sharp cut is always better. The recovery will be faster, but recovery will be sharp. But it's not a consolidation. You have to let the market get the cuts. So short answer, don't buy the decoupling thesis. Don't buy the domestic thesis. If there is trouble in the US, it will come knocking on our doors also. Eventually, it might take a month later. And anybody who went through 2008 knows that, or you went through 2000. I mean, what was Brexit to do with us? What was taper tantrum to do with us? China today has started depreciating its currency. We cannot close our eyes to that. To stay competitive. Now, last time they were taking care of a 10% tariff in 2018-19. Now it's a 104% tariff. I don't know what will they do and what will we do.
all tenets of macro and micro get thrown out. What do you do? You are absolutely right. What do you do when 104%? All talk is idle talk. How do you respond to that? You know, no, but this point that you make, as we wind down, Atmanirbhar Bharat from a manufacturing point of view has been a journey on which we have been, and you know the results are there for us to debate, and we will see what opening up we end up doing and which sectors get impacted. There is some conversation that even dairy and agriculture are on the table for conversations. But one thing is clear, and I don't know if you will agree with me, that as far as markets are concerned, we have now decidedly proven that we are a Atmanirbhar market to a large extent.
Yes, and that's very good. And that is, Siddharth, with 5% of household savings on a gross basis are still in the market. So you have not reached the 62% of US or things like that. 62% population, but 30% of savings. We are just 5%. We buy much more gold than we buy equity.
You know, any bank chairman, executive, listening to your comments from 5% to 60% must his worries on raising savings will continue to increase, because if we go down that route, what happens to our banking system? You know the pressures that they've also been facing, Ajay.
Yes, absolutely. No, the models have to change. The worldwide, 20-30% of AUM will move to equities. It's not coming for the next 20 years, so that's a good thing. I have seen even when Ronald Reagan brought in 401k, the total US mutual fund industry was $60 billion. But the product was so beautiful, fill it, shut it, forget it, automate the deduction, and your PF goes into a 401k into equities, that today you are in trillions of dollars. I never thought there will be companies with a $1 trillion AUM. Now there are companies with 11 trillion, $15 trillion. So,
but as you have noticed, Ajay, on social media in the last few days, 401k has become 201k.
201K. That's a nice one.
But that's the thing, viewers. Ajay Bagga has covered a lot of territory here in this conversation, and if you follow him on X, or what I still prefer to call Twitter,
Yes.
you will get a sense that at these times, markets which many a times ignore fundamentals, live in their own territory, valuations disconnected from fundamentals. This is a time where fundamentals rule, basic logic, common sense approach to investing becomes very, very important. And perhaps my takeaway from what Ajay Bagga has said, ignore the noise, because you cannot process, digest and analyze all this noise. The whole world is in turmoil. We are seeing what is happening to the markets. History offers us some guide, but you have to live in the present and make a smart call. And that's why perhaps the next 6 months require all investors to be very, very smart. Ajay Bagga, thank you very much for your time with us here today, for sharing your wisdom. And hopefully these insights that you have shared will help all investors mind the twists and turns on the pitch that are being delivered almost every day. Thank you very much for your time. Viewers, with that, it's a wrap on this episode of Market Guru with Ajay Bagga. I'll keep coming back with more. We slip into a short break. Do stay tuned in. More coverage on the other side of a very short break. Bye-bye.